Kitco News, special coverage of the Vancouver Resource Investment Conference, is brought to you by First Mining Gold.
We're examining the macroeconomic landscape around the world with Tavi Costa. He is the portfolio manager at Crescat Capital. Welcome back to the show, Tavi.
Thanks for having me.
Haven't spoken to you in a while. We're in person here at the VRIC in Vancouver. There's been a lot of buzz about how gold may be making a comeback, but we'll talk about that with you. I want to first talk about your macro thesis. You've been telling me offline there's a series of imbalances. We won't go through the entire list, but generally just top three drivers of the sell-off that we've been seeing in both cryptos and equities. Basically, risk assets have been selling off. Why?
I think it's hard to pinpoint one or two cases, but mostly it has to do with cost of capital rising and the valuation of things now being harder to justify. We are facing a trifecta of macro imbalances today. We have the debt to GDP problem of the 1940s. We have the inflation problem of the 70s. And on top of it, we have the speculative environment that we had in the late 90s and late 20s as well. And so it creates real political constraints at a time when we've seen too much allocation going into tech. You look at the CapEx trends of technology companies relative to commodity producers. They're both been diverging historically as well. And so all those capital flows are now finally shifting back again. So we're seeing growth versus value. Stocks in the growth environment starting to sell off significantly at the same time as we're seeing natural resources catching a bid. And so tangible assets, inflationary assets, and the 60-40 portfolios, crowded portfolios now starting to suffer from those shifts. And so that's where I'm mostly focused. Those big trends and those opportunities are going to be setting on because of those changes.
Tavi, a lot of capital has flown out of risk assets. Yep. Where have they gone though? Because I'm not seeing gold move up.
Yeah.
I'm not seeing, treasuries and the dollar have been doing okay, but where's the safe haven right now? Is it just cash?
It's interesting. Among developed economies, I would say the dollar has been catching a bid. So now emerging markets surprisingly have done quite well in the last months or so. I would say that the majority of capital has been chasing tangible assets still.
Yeah.
If you looked at energy just had, the energy sector and oil A&P companies just had their best annual performance in 2021 in 30 years. We've had agricultural commodities doing very well too. And since the war broke out and the geopolitical tensions is starting to really become a problem, we've had most of that move towards tangible assets. Housing has been doing very well too. So yeah, there's a lot of shifts in portfolios right now. I think big, large institutions are starting to catch on that there are a lot of early stage secular trends starting to unleash. And so one of them is certainly the commodity space.
Let's talk about a coming recession, if there even is one. Some people I've talked to have said that there is a coming recession. Goldman Sachs just recently made a statement that we're very, very likely to have a recession. What's your view?
I'm on that camp. I think we're at peak margins right now. We've had ISM manufacturing starting to roll over. If you start looking at other things that tend to lead profit margins in general, I think we're starting to see that show or suggest that we're going to see a major contraction. Energy cost is rising, labor cost is rising, we're seeing cost of capital rising, so that should lead to a squeeze of margins of corporations. So I'm very focused on that. When you look at the FANG stocks, for instance, FANG stocks in terms of revenue growth is in a declining trend, one of the worst declining trends we've seen in the last over a decade. Yeah. And so I think there's a lot of issues when it comes to the economy right now. Energy costs rising is certainly very challenging for consumers. We're seeing even saving rates declining to levels that we haven't seen in many years. Right. And so it's hard to believe that the economy is going to do very well in the next 12 months with all those leading indicators telling me that we're probably going to get to a recession.
Is it traditionally customary to have high levels of inflation before a recession hits? When you think about the economic cycle, you have an expansion, then a contraction. We were in a contraction phase because of COVID, then a very quick, rapid expansion, and now we're talking about a potential slowdown. I'm just thinking whether or not this inflation scenario that we're getting right now could actually be the cause or the root cause of this coming recession. What do you think?
For a lot of folks, I would say that what's happening is kind of reminiscent of what happened in 2008. I'm not in that camp at all. I think what happened in 2008, the CapEx in aggregate was for commodity producers was significantly higher Just looking at energy companies, for instance, it was about 3 times what they do today. I think today they did, just in the last 12 months, about $40 billion in capital spending. Back in those days was about $140 billion. And so the differences of how they were, the infrastructure development for those companies and the industries in that space was significantly different. So I think the supply constraints and the structural changes in inflation are much more severe than what we saw back then. We're seeing the wages and salaries growth. I think that's a big part of the inflation trend. We're seeing, the CapEx situation that I think takes a long time to reverse. On top of it, we're seeing one of the strongest and most aggressive fiscal policies we've seen relative to where unemployment rate is and where inflation is as well. And then we have deglobalization trends right now happening. So I think that's going to feed the inflationary problem for much longer than most people believe.
Okay. Inflation is a hot topic. Deglobalization is not something that we talk about a lot in our show, so let's delve into that. You mentioned that. What are the signs of deglobalization you're noticing right now?
I think one of the things that we're seeing right now is defense spending at a 3.3% right now, which it's a really interesting chart all the way back to the 60s and 70s.
3.3% of GDP, to
clarify.
GDP,
correct. Yes. Back in the 60s and 70s, we used to spend somewhere close to 9% of GDP, and the 40s was much higher than that.
That's true.
And so what's happening with that is that we believe with geopolitical tensions and the industries of defense spending here in the U.S. being significantly more developed, I think NATO countries as well, looking for ways of investing in defense and military spending, are going to actually unleash somewhere close to $1 to $2 trillion of capital coming into the defense industry. The defense industry right now generates somewhere close to $250 billion of revenues, and this is just looking at public companies. I think that we're talking now 3, 4, 5 times what they earn in revenues today when it comes to the unleash of capital. So this is going to be not only a fiscal story, but also the continuation of those trends will lead to, I think, a lot of opportunities in defense companies.
This inflow of capital into defense, what does that mean for the commodities complex?
It's an interesting part because the deglobalization trends are not just in defense stocks. It also has to do with manufacturing. So manufacturing used to be 30% of GDP. Now it's somewhere close to 10%. So if we're doing less businesses with other parts like China, I think what we're going to see is the rebuild and reshaping of manufacturing in the U.S. That's going to drive non-residential construction here. And in my view, that's going to be the second wave of the demand for commodities when it comes to the long-term thesis for those things. Residential is also probably going to see a major construction wave. And so all those things are going to play a role. But think about any company establishing their businesses today in the U.S. It's hard to believe they would set up a plan with China, with any manufacturing plant in China, to have their businesses in the long term, 5 to 10 years, having a relationship with a country like China. So there's a lot of balance of powers that are going to shift when it comes to geopolitical powers. I think China, it will suffer from those shifts when it comes to especially capital flows.
You have a chart here that's interesting. It's called Debt Valuation and Inflation. 3 panels on the top is U.S. government debt to GDP. We're at 98%, which is the highest in 40 years, according to your chart. The S&P cyclically adjusted PE is also at the highest level since 40 years ago. And the consumer CPI, well, we know how that's changed over the last couple of decades. What does this chart tell you from a global macro picture?
Well, I think we've never seen something like this. I think we all, as investors, like to go back in history and look for analogs. And yes, the 70s is an interesting time. We certainly had inflation, but we didn't see the debt to GDP problem we have today. We didn't see the speculative environment we have today. In the 40s, we certainly saw the debt to GDP problem in sporadic inflationary problems, but the dollar was back to gold, number one. Number two, we saw a very different tax policy. And number three, we had a war happening at the time too. And so there was a lot of differences. It was much more sporadic what we saw when it comes to inflation. And in my view, this is very unique. It creates real political constraints when you have, especially market cap to GDP at the levels that we have today, 15% above what we have back in the tech bubble in the 90s. And so to me, I think this is setting up a place where the Federal Reserve and central banks cannot tighten monetary policy too much. it's an incredible opportunity for tangible assets and an incredible opportunity for commodities.
I was going to ask you how people can actually play the inflationary story. Inflation is bad for investors on a lot of levels. It erodes your wealth if you just have cash savings. If you're invested in certain tech stocks, maybe that hasn't done well during inflationary periods. If you're invested in certain companies like Walmart, for example, just missed earnings, their margins have shrunk. And so inflation really hurts costs from the equity side. But how can investors actually profit from inflation? Can we do such a thing?
I think there's a kind of a fallacy in markets that inflation actually benefits stocks, and that's not true. Historically, in the 70s and 1910s, which I think are the best inflationary environments to look back, the real return for equity markets was negative. And even in nominal terms, was actually pretty flat. And so I think it's, the opportunity really is in tangible assets, in my view. Most of our focus has been in miners, has been in energy companies, in agricultural companies, in uranium. You can set up a portfolio that has a lot of opportunities in natural resource space today, which is still at depressed levels relative to any other asset you look at. And so profitability is at all-time highs for a lot of companies today. And in my opinion, what is interesting about this is the valuation spectrum relative to overall equity markets. And so I think that's where you want to hide. I think there's a lot of opportunities, certainly no shortage of things to do with capital right now.
Okay. Can you give us some ideas of sectors that you do like right now?
Sure. We've been investing a lot in precious metals.
Yes.
There's a lot of exploration companies. I think we're going to see exploration age in order to really feed the world that needs a lot of natural resources, and we have been underinvested not only in the capex trends, but really in exploration budgets. And I think that's going to lead to larger companies buying into the high quality assets in exploration.
Okay.
I think there's a lot of opportunities in energy. Certainly, production companies, the larger companies, are trading at very, very cheap multiples. No, companies that steel producers, Brazilian companies, I think look really cheap and interesting, given the fact that it's a commodity exporter. It should benefit well from this inflationary environment. I think there are shorts that are great opportunities too. You can find shorts in the technology space. We're short most of the FANG stocks. We have shorts as well in the Chinese yuan. We have shorts in the Hong Kong dollar. Those are all ways of hedging a very long inflationary book. So if you think about our portfolio, majority is very long inflation, and then we have some hedges, which is mostly in equity markets, and I would say being long the dollar. So the way to think about this is being long commodities and short equities, which is a famous chart of the commodities to equity ratio being a 50-year low.
Does that imply that the equities will come back down, or the commodities will catch up to the equities?
Well, I think there's a possibility of decoupling of the two, which we've seen the market leadership change right now with energy being up, for instance, just looking at the equity markets in the US versus the rest of the market declining. I think there's a possibility of that, but I don't need to be right on that. I just think that the ratio is going to be higher.
You have an interesting chart, and I'd like to tie this back to your miners thesis. So you have U.S. market cap to GDP as a percentage, and you've got this line that shows the peak of the tech bubble and a question mark going down, perhaps maybe 15%.
Yes.
Are you implying that the market cap is going to retrace, the market cap of equities is going to retrace back to the peak of the tech bubble? Which is around 150% of GDP, which implies more correction for equities? Is that what you're implying?
I think there's more correction to equity markets. I think we're at the beginning of bear markets, and sure, we're going to see bear market rallies and relief rallies, like kind of what we saw today. However, I do believe that the environment we're in, it's hard to justify valuations that we have today in equity markets, especially when you have cost of capital rising and the Federal Reserve being forced to tighten monetary conditions the way it is doing. And so I believe that we're going to see valuations being re-rated, especially for technology companies and perhaps the very mega cap companies that today are, supposedly for every dollar coming into the S&P 500, imagine how much is going to FANG stocks. What if we have an outflow of those dynamics? I think that's going to hurt the FANG stocks in a big way. So I think there's a lot of ways. Just to go back a little bit, in 2021, we saw most of the kind of high valuation profile, hyped overvalued names, especially software companies, have suffered, ARK investments and so forth. I think the next wave is going to be mega cap and also companies that are going to be hurt by the squeeze of margins. So that's where my focus is on that hedge part of the portfolio.
Why did you pick the peak of the tech bubble as your support level?
Well, I don't think it's going to be a support level. I'm just putting into perspective of how historically we are very expensive. Just think about this. Nasdaq is down about 27%
Yes.
or so. Back in March, it declined somewhere close to 30%. The Fed panicked at that time. They had to print a ton of money. They had to expand their balance sheet. And we've seen all sorts of policy making in order to support equity markets and save the economy. Today, we're quite the opposite. We continue to hear more how much more they're going to be raising rates and remove liquidity from markets. It's a very different environment. Corporate bonds are already down as much as they were back in the March crash.
Yeah.
VC are down 50%. So the list is long of the damage already in the markets.
Now, if you think that equities have more room to climb down, to drop, in other words, don't you think that would also pull down the mining stocks?
There's a possibility. I think we've been conditioned to fight the last war and think about what happened in 08 and 2020, and even back in other times that we had a reckoning moment for equity markets. But I think it's important to go back to what happened in 1973, 74, when we saw actually the miners go up fivefold at a time when equity markets are declining. Again, I don't need to be right about this. I think the ratio thesis is, or the spread trade of being long commodities, natural resources, and short equity markets is the really compelling thesis here. But I do believe that there is a case to be made that things could actually decouple from each other.
Okay. I have a few more charts that I'd like to show the audience. You've got a treasury yield chart. Now, yields have been ticking up. That's without a question. Do you think yields will continue to tick up? I'm tying this back into gold because gold really doesn't like higher interest rates.
Yeah, I do think that yields could potentially go higher. And I think that it's important to go back to the 70s. And I'm not claiming we're going to see 10-year yields at the same levels we saw in the 70s. But 10-year yields in nominal terms are actually more correlated to gold than in real terms back in the 70s. So
interesting.
It's important to remember that. But I do think that there's too much or not too much attention on what's happening when it comes to the issuance of treasuries. We're seeing somewhere close to $800 billion of issuances of treasuries in the last 3 months. The Fed was the largest buyer of that.
Yeah.
They were buying 50% of that. They're not buying anymore. They're talking about selling.
Right.
Banks were buying a large percentage of that too. They're buying about 20% of the issuance. Large corporations outside of the U.S., they used to be the largest buyers. Now, with the geopolitical tensions rising, I highly doubt we're going to see the same strong demand that we saw over the prior years. So there's a lot of similarities with the 40s when it comes to this, maybe a flexibility from the Federal Reserve to come in and either reverse their current trends when it comes to tightening policy or cap yields at some point. I think that's the second wave for gold and tangible assets when there's some sort of monetary easing in an inflationary environment. I'm very focused on that.
Well, when I asked you earlier what could do well in an inflationary scenario, how you can profit from inflation, you didn't mention gold. You don't think gold is one way to play inflation?
No, I do. I'm very long gold. It's a very large percentage of our portfolio.
Yes.
Not only gold itself, but really the miners.
Yes.
I think there's a lot of inefficiencies in the mining space. Unfortunately, we've seen a sell-off recently not unfortunately, if you're a long-term investor, what an incredible opportunity to accumulate assets in the space too. But it's been a tremendous, I would say, pullback here for gold and the miners, and I think it's undeserved. But anyways, there's a lot of opportunities. We've been with a lot of geographic focus in different parts of the world. I would say the Golden Triangle is something that we have a very large exposure to. We've got Newfoundland, Nevada, some parts of South America, but I would emphasize it's a very big percentage of our portfolio right now.
Okay, and finally, if you were to deploy capital now to a geographic location, domestic equities or foreign emerging markets, what would you prefer right now?
I don't have a view that way because I think there's different parts of emerging markets. So
Yes.
it's not easy to answer that question that way.
Okay.
I would not allocate in China. I would not allocate in India. I would allocate in Brazil, and I would allocate as well in some parts of the U.S. when it comes to natural resource companies. I think Canada has some great companies as well in the natural resource space. But yeah, I would favor some other parts of the world like Brazil.
Well, a lot of emerging markets debt, especially in the Latin area, their debt is denominated in U.S. dollars. Do you think that the strength of the U.S. dollar has hurt emerging markets' interest payments and expenses?
I think that's the potential. Part of the thesis is that sure you can see some of the emerging markets get hurt that way. I think Brazil is in a different position when it comes to the historical correlation of of commodity producers global commodity producers relative to the equity markets in Brazil.
Yes.
Brazil has a long history of fighting inflation. It has been way ahead of the curve than the Fed and other developed economies when it comes to dealing with inflationary problem. And so I believe when you looked at valuations today in Brazil, it seems just opportunistic to just allocate part of your capital there. And I think, it's been a good investment so far, and we think will continue to be.
All right, Tavi, I appreciate your thoughts. Thank you so much for coming back on Kitco.
Thanks.
Thank you for watching Kitco. We'll have more for you at VRIC.
Kitco News, special coverage of the Vancouver Resource Investment Conference, is brought to you by First Mining Gold.